Hi, welcome to EQD Research Global Insights for Tuesday, May 25th. Today, we're going to check in on global volatility and we're going to check in on industry volatility or sector volatility here in the US. But before I get going, please hit that like button. Helps me an awful lot with the YouTube algorithms. If you haven't done so yet, please subscribe. Is this your first time here? Welcome. I hope you like what you see. I am always wide open for feedback. I share my email address at the end, but I am trying out something new today. I really would appreciate some feedback in the comments section below or constructive criticism via email. I'm always wide open to. So first, we're going to check in on the major global volatility indices. And what I did was I took a look at where each of these indices are relative to their 2021 average. The longer the bar is to the downside, the cheaper or lower the volatility of each of these indexes is compared to the 2021 average. Two of them are actually a little bit above their average, and they have something in common. It's VVIX, which is the VIX of VIX, and VVSTOXX, which is the volatility expectations of the VSTOXX. On the cheap side, VHSI, the Hang Seng implied volatility, is very low. In the US, the Russell 2000 and the NASDAQ 100 volatility is very cheap. Now, I got a theory on why those two are relatively cheap, and it has to do with trades that I am consistently seeing in both complexes. Vertical spreads, both bearish and bullish, they're just showing up frequently for both the Russell 2000 and NASDAQ 100. So I'm going to give you a couple of examples of what I'm talking about. So first, yesterday morning with the NASDAQ 100, just after the open at 13,560, somebody came in and sold the June 14,500 calls and purchased the 14,525 calls. They took in a credit of $1.25 on this trade. And this trade works out as long as the NASDAQ 100 is not above 14,500 at June expiration, June standard expiration. That's a nice 6.9% buffer. And then turning to the Russell 2000 complex, today with the Russell 2000 near 2225, somebody came in and did a bull put spread, selling the June 1960 puts for 466 and buying the 1950 puts for 435. That's a net credit of 31 cents. Got a risk of 696 on this trade, but a buffer to the downside of 8.8%. So the Russell 2000 really does need to make a dive to the downside for this trade to be in trouble. And then turning to sector volatility. What I did for the volatility measure of each of the 11 iShares sectors that make up the S&P 500 was I downloaded the 30-day at-the-money implied volatility from Bloomberg and then compared where we are right now to where each of those averaged over the course of 2021. Again, the lower this bar is, the cheaper the volatility is. Consumer staples and utilities, that's where the cheap vol is. Where is it relatively expensive? Three areas that popped out at me here, materials, energy, and industrials. They may be impacted positively or negatively if we do get a bout of inflation. So that's my theory behind those three holding up. So I went out and I took a look at where volatility is cheap. Were there any long option trades out there? Anybody taking advantage of it? And with the XLU utilities trading at 65.40 this morning, somebody came in and bought 800 of the June 18th, 62 puts for 18 to 19 cents. There's a little bit of a buffer before this trade starts to break even, but also worth noting is the XLU was already down 1% on the day when this trade went off. So somebody's really concerned about lower utility prices or speculating that utility prices are going to move lower. On the short side, where the volatility was kind of expensive, I mentioned energy. Somebody sold just over 24,000 of the June 55 calls on XLE, took in 50 cents. XLE was at 51.60 at the time. The result is a break even up about 7.5%. And then checking in on the industrials, XLI this morning when it was at 103.70, somebody came in and sold the July 103 puts, standard July 103 puts for 260. Break even on that trade is down about 3.2%. So just checking in on where implied volatility is for broad-based indices and sectors. and seeing how people may be taking advantage of where volatility is cheap and where volatility is expensive, because in the option market, you can take advantage of both. So thanks for joining me for EQD Research Global Insights for May 25th. Again, if you've got any suggestions on how to make this program better, any suggestions on the work I did today, feel free to put them in the comment box below. If you stuck with me this long, the cost is hit the like button. And again, if you've got more in-depth comments, got any kind of questions or suggestions of things you'd like me to talk about, today was actually a suggestion from one of you guys. You can reach me at rhodes@eqderivatives.com.